All right, so in this lesson of the Elliott wave theory, we will be focusing on multi-timeframe analysis. So at this point, you already should have a really good understanding of what the Elliott theory is and how the waves work, the 5 waves. We already looked at the waves, what a complex pullback is, what a simple pullback is, what a corrective wave is, and so on. So you should already have a pretty good understanding of how the Elliott wave theory works. Now, it can get a little bit more complex, and that is Elliott wave theory using multi-timeframe analysis, right? So that's the same understanding of a run on a higher time frame is a trend on a lower time frame. So now we also know that a trend, within a trend, we have these 5 waves. Wave 1, 2, 3, 4, 5, right? That forms a trend. So coming back to this multi-timeframe analysis concept, a run on a higher time frame is a trend on a lower time frame. That's what we're going to be focusing on here. But think of this too, right? If we believe that a trend is developing, okay, so let's say we had a wave 1 breakout, a wave 2 pullback. That is the start of a new trend. That is also the start of the waves, the 5 waves, right? So if a new trend is beginning, that means that a new run or a new pullback is also beginning on a higher time frame. So a lot of times we could literally have a wave 3 run on a monthly chart, right? So let's say we have a wave 3 run on a monthly chart. That wave 3 on a monthly time frame, if you drop down to the lower time frame, such as the daily chart, that wave 3 run, a run on a higher time frame, is a trend on a lower time frame. So wave 3 run on a monthly will be 1, 2, 3, 4, 5 on a daily. It will be a whole trend on a daily chart, right? Same thing if it was a wave 1 run on a daily, as an example. If we have a wave 1 run on a daily, a whole breakout on a daily time frame, it's a run. Well, on a lower time frame, such as the 4-hour or the 1-hour, that would actually be a 1, 2, 3, 4, 5, a whole trend, right? Because a trend on a lower time frame is a run on a higher time frame, right? So that's how that is what Elliott wave theory and multi-timeframe analysis is, right? That is also the fractal principle, right? That Mr. Elliott talked about when he developed the Elliott wave theory. He talked about fractals, right? That is pretty much, it means that the same patterns will continue to repeat themselves as you go lower and lower and lower and lower, right? Literally. So that's what I mean. A wave 3 run on a monthly, or a wave 1 or wave 3 or wave 5, whatever happens on a higher time frame, it will repeat itself on the lower and continue to repeat and continue to repeat. So eventually a wave 3 run on a monthly will be a 1, 2, 3, 4, 5 on a daily. A wave 3 run on a daily will be 1, 2, 3, 4, 5 on a 1-hour. A wave 3 run on a 1-hour will be 1, 2, 3, 4, 5 on a 5-minute, right? It just continues to repeat, utilizing that fractal principle, right? So that is, again, multi-timeframe analysis. I hope that makes sense. If it doesn't, obviously continue to watch this multiple times over and over and over again. And the thing is, this is something that we're going to be applying over and over and over again as we go through this whole masterclass. So this is not the last time that you will be seeing this. You will literally be seeing this over and over and over again in the strategy lessons, in the management lessons, and even after that, when we start digging into even a little bit more advanced concepts. We will, at the end of this masterclass, we will put all of this together and it should all make sense. And at that point, I would say come back to these lessons and watch them over again, because it will even make much more sense once you go through the whole masterclass and come back to this. So just make a mental note of that when you go through it all, come back to some of these lessons, specifically multi-timeframe analysis, Elliott wave theory, the strategies, and just watch them again. They will make so much more sense after that as well. So that is it for the quick intro into Elliott wave theory and multi-timeframe analysis. Let me show you some examples of what I actually mean. I'll draw out some patterns and show you a few live examples as well. So let's have a look. All right, so this is going to be a 2-part process. I'm going to show you some live examples and also go back to that same drawing that I did before, showing you the 1, 2, 3, 4, 5 and the Fibonacci retracement and extension right from that lesson. And I will build on that a little bit more to kind of finalize the Elliott wave theory and multi-timeframe analysis concept. But if we look at this chart right here, this is an example that I showed you from the previous lesson. This is an Aussie dollar chart on a monthly time frame. So this is a monthly chart. And just look at these patterns, right? I just want you to focus on this for a quick second. We have this breakdown with this pullback to wave 2, hiatus reversal, we have some sideways consolidation, we move down to wave 3, then we have this flag pattern, right? This rising flag, breakout, finish of wave 4, breakout, and continuing into wave 5. You see how, just do a mental image of this for a second, or if you want, even take a quick screenshot of this for a brief second. And now let me show you something else. Now check this out. I want to show you something, and the whole idea that these patterns continue to repeat over and over and over again, and obviously they can differ a little bit here and there. Sometimes a wave 2 pullback will be a complex pullback. Sometimes a wave 4 pullback will be a simple pullback, and so on. But check this out. Doesn't this look exactly the same as the previous one? We have this wave 1 breakdown, wave 2 pullback, little hiatus reversal, some sideways consolidation, a big wave 3. Then in the previous one, we had a flag pattern, a rising flag. In this case, we have a rising wedge, a complex pullback, A, B, C, and then it continues into wave 5. It's the same. It is literally the same. Take a screenshot of this as well and then compare the two images. And then you'll notice it is the exact same pattern. But they're different because this is a totally different pair. This is a Kiwi yen on a daily chart, whereas the previous one was, I believe, Aussie dollar on a monthly time frame. Totally different time frames, totally different currencies, same patterns. This is what Mr. Elliott, I'm just going to call him that, when he developed the Elliott wave theory, he said that these patterns continue to repeat over and over and over again. And when you truly understand that concept, I mean, it will help a lot. And this is just another example that this does repeat over and over again. Doesn't matter what time frame you look at, right? That whole idea of these 5 waves, they just continue to repeat over and over and over again. So this is just a quick example that I wanted to show you, but let me go a little bit deeper into this. And I'm going to jump right back and do the same kind of live breakdown of how I did it before in the previous lesson. So coming back to this example here, check it out. So we have the wave 1 breakdown, and I would say that this is a wave 1 breakdown because when you draw in this little trend, we actually broke down. Let's draw it this way, right? We broke this bullish little trend. This could be seen as a potential kind of corrective wave, right? Where we have this larger kind of A, B, C pattern going on. And then here we broke down. So I would say this is the start of a wave 1. We actually broke down. So this will be the start of a wave 1. I'm just going to put a 1 in here. And then we draw our Fibonacci, right? So Fibonacci retracement to measure the pullback. And you can see here we beautifully pulled back, gave a hiatus reversal rejecting the 50 EMA and 0.38 to Fibonacci. And again, I mentioned multiple times that a lot of times on these pullbacks, the 50 EMA lines up with 0.32. That's why that ends up being a very good support or resistance level. So we have a rejection of 0.32, and let's see what happens. Boom, confirmation. So I would now say that this is the end of wave 2. And now we're potentially beginning a wave 3 run. So to measure a wave 3 run, we're obviously using Fibonacci extension for that. And this is kind of what we're predicting. Now, the one thing that I want to mention is that sometimes when these breakdowns are very shallow, right? Because this is a very shallow breakdown, literally lasted like 1 candle. Sometimes they can continue going a little bit farther. Wave 1 can continue going a little bit farther. The larger the runs are, the larger the future runs will be as well. So if wave 1 is a really decent breakdown, it's a very large breakdown, wave 3 run will be pretty significant as well, and wave 5 run will also be pretty significant. Sometimes if wave 1 breakdown is really shallow, these targets will be quite small as well in comparison. So I'll show you exactly what I mean here. So now we've measured wave 3 run. So obviously the potential target for wave 3 run will be 1.272 or 1.618, which is still pretty good. If you enter this on a day trade, that would be a massive profit. So check it out. We continue, then we consolidate a little bit, popped one more time to the upside, and now we're falling. So there's some consolidation, and now we're moving to wave 3. Now we're fully in wave 3 here. A little stalling at 1.0, but we continue farther down, and look at that, we gapped straight down. So sometimes these gaps happen when the market closes, and there's a significant event when the market is actually closed. So in the FX market, the market closes every single weekend. So in this case, something must have happened over the weekend that caused this price to gap down. The stock market closes every single day. So in the stock market, we have these gaps every single day because sometimes news announcements drop after the market closes, and when the market reopens, we could have a gap. So these gaps happen once in a while in FX. In cryptocurrency, I mean, the gaps barely happen because the cryptocurrency market is currently open 24/7. But in FX and stocks, this happens when the market is actually closed, and there's a significant event that occurs when the market is actually closed. So just wanted to touch a little bit on gaps here. But anyway, we gapped right through 1.272, and now we're sitting at 1.618. So if you enter this with a swing position or a day trade somewhere over here, I mean, you're looking, your top profit targets are already being hit right there. But it doesn't stop. It continues farther. Look at that. It's dropping even farther as we're moving through this. And right here, this is a potential pullback. So it looks like maybe a wave 4 pullback is happening right here. But see how much farther we went through 1.618? Sometimes this happens. It's called an extended wave, right? So sometimes we do have this extended wave. It's still going to follow the same type of principle of wave 1, 2, 3, 4, 5, right? But sometimes wave 3 can be a little bit extended. Sometimes wave 5 is also a little bit extended. And in this case, I would say it's extended because wave 1 was so shallow so that these targets were not necessarily accurate. But check it out. If we take this and add 2.618. So remember, 618 is a very significant number when it comes to the Fibonacci sequence. 618 is very significant within the Fibonacci sequence. So 2.618 is another significant level. And if we toss in 2.618, let me just make this a little bit brighter. Look at that. So we have this red line now, which is 2.618. And that was hit, right? So that was hit beautifully and rejected it and now caused that pullback. So Fibonacci still works. I mean, 1.618 and 1.272 majority of the times that's what will be hit over and over and over again. And those levels are the most significant. But sometimes when we do have these extended runs and they continue to break down, then the next major support level or resistance level or the next major Fibonacci level will be 2.618. And you can see here that was rejected beautifully. And then now we're measuring a potential pullback, wave 4 pullback. So we start at the top of wave 3 to the bottom of wave 3, right? And I would say now this is the end of wave 3 because we're beginning this pullback. So this was an extended wave 3, and now we're going into this pullback territory. And it didn't even pull back. Oh, here we go. So we got a little bit more deceleration here. So that was just decelerating a little bit more. And now we're rejecting that. So this can be seen more of kind of a corrective wave, right? But let's see what else happens here. Yeah, so this is a complex pullback. We have an A, B, or kind of like an A, B, C pattern going on here. Because this was a pretty quick pullback with some consolidation. This is actually a complex pullback, right? So this is a little bit more complex now. It develops this ABC pattern. So now let's say wave 4 should end when we fully break down, right? So if we kind of connect the lows, so using the wrong trend lines here. So if we connect the lows, right, and you can always connect the lows like this, or you can connect the lows with the open and close prices instead of the wicks, kind of like that, right? So sometimes the way you draw trend lines, just make sure that it's either the open and close prices or the wicks, the bottom of the wicks or the tops of the wicks, right? Not both together. Sometimes I find that people start drawing trend lines from the open and close prices, and then they end up connecting the wicks, and it's just random. And I mean, when you draw trend lines like that, you can have so many different possibilities. I mean, you can just continue drawing many random trend lines here, you know, and every single one of them is pretty much going to be different. So we want the trend lines to be as accurate as possible. So it's either going to be open and close prices if you draw a trend line, or wicks, not both together. All right, that's just my personal opinion. So check it out. So now we're developing this pattern. And if you just connect everything, it looks like a potential rising wedge, right? So let's see what happens. And here we have this breakdown. So now we're breaking down. Let's see if this looks a little bit better. Yeah. So in general, I mean, you can draw one connecting the wicks and one connecting the bodies. I mean, the bodies will typically open and close prices are like right here. You know, so it's roughly a rising wedge. This would be considered more of a rising wedge, right, when you look at it this way. And now we're breaking down. So we rejected roughly this 0.32 region, which was right there, and it went a little bit higher, in this case to 0.5, to give us a wave 4. There we go. And now we're starting wave 5. So again, measure it using Fibonacci extension. So top of wave 3 to the bottom of wave 3 to the pullback of wave 4 gives us some targets. So previous lows is a decent target, 0.618 is another target, or 1.0 is the next target. So let's see what happens here. And we just smash right through it all. Look at that run. You know, so we don't even stall at 0.618. There's a lot of momentum here, a lot of volatility. Something's happening in the market. So there's a lot of pressure. So it looks like we're heading all the way to 1.0 actually. Yeah, and there it is, 1.0 is being rejected. And we're slowing down exactly at 1.0. So this is an example of when there's so much volatility in the market, these runs can continue going a little bit farther. We had an overextended wave 3 in this case. Wave 3 went all the way to 2.618 instead of 1.618. So there was just a lot of bearish pressure. And then wave 5 did not stop at 0.618, just went directly to 1.0, which will be the last major target for wave 5, will be 1.0. And in this case, that's where we started to slow down. So that is now the end of wave 5. And that was just another example of how this works, right? But now let's start talking a little bit about multi-timeframe analysis. How does Elliott wave theory actually is applied with a multi-timeframe analysis? I went a little bit deeper into this example, but multi-timeframe analysis, again, the idea that a run on a higher time frame is a trend on a lower time frame, right? A run on a higher time frame is a trend on a lower time frame. So if you look at this, a run on a daily chart, such as this wave 5 run, okay, this is a run, wave 5 run on a daily chart should be a trend on a 4-hour or the 1-hour time frame. So trend being 1, 2, 3, 4, 5. Let's have a look. Again, it's the fractal principle. So if we take this and look at a lower time frame, let's do that now. So the same daily run, if we look at the same run on a 4-hour chart, what do we get? So check it out. This is the 4-hour chart at the exact same time that that monthly run or that daily run was developed. So you see this begins on July 22nd and ends pretty much right here in roughly August 13th. If you go back to that daily time frame, this run began on July 22nd and ended roughly right here on August 13th. So we're looking at the exact same thing, but on a lower time frame. And you can see that this was a wave 5 run. Run on a higher time frame is a trend on a lower time frame. Check it out. We got a wave 1 breakdown, wave 2 pullback, wave 3 run, wave 4 pullback, wave 5 run, deceleration. Bullish MACDs coming in. Looks like the whole wave count is now concluded and we might start something fresh. And when you look at the higher time frames, we also concluded a wave 5 over here, so we might actually be beginning something totally different, right? That is Elliott wave theory using multi-timeframe analysis. That's how simple it is, right? So it's the whole understanding that a run on a higher time frame will give us a whole wave count on a lower time frame, right? Just the same idea applies if we believe that if we go back in time right here, if we actually jump to this point right here, we believed that at this point we have a whole brand new trend developing on the 4-hour chart right here, because we were riding this bullish trend and then we fully broke down. So we're assuming that this is a wave 1 breakdown, right? And a potential new trend is developing. So in this case, it never even pulled back to 0.382. I'll talk about that in a second. But you see how this is I'm assuming this is a wave 1 breakdown when I see it like this, right? At the same time, this was July 24th. So I believe a new trend is beginning here on this lower time frame, a new trend developing. So if we jump back right here, I mean, this is July 24th, right here. So a new trend on a lower time frame will develop a new run on a higher time frame. A trend on a lower time frame is a run on a higher time frame. It's the same idea. So as soon as this 4-hour chart started to break down, that gave us confirmation that this 4-hour or this daily time frame, this wave 4 actually came to an end, and potentially we're developing a brand new run on a daily time frame, being this wave 5 run, because on a lower time frame we're beginning a whole new trend: wave 1 breakdown, wave 2 pullback, wave 3 run. A trend on a lower time frame is a run on a higher time frame. That is, again, Elliott wave theory applied utilizing multi-timeframe analysis, right? It might seem a little bit complex now. I mean, to me, this is very straightforward at this point, but I've been doing this for a long time, right? So if this seems a little bit complex to you, I will go a little bit deeper and explain this a little bit more. But after a while, when you go through the entire masterclass and you come back to this lesson, it should make much more sense. So let's just fast forward through this. And we have, so now we know this is a whole wave count right here: wave 1 breakdown, wave 2 pullback, wave 3. This looks like an extended wave 3 run, because I mean, look how much volatility we had here when we fast forward on this daily time frame. That's a lot of volatility. We smashed right through 0.618, so we never really slowed down. If we were about to reject 0.618, I mean, on the lower time frames, this would be slowing down much quicker. Wave 4 pullback would be somewhere over here instead, right? But instead, because of how much bearish momentum there was, wave 4 pullback just occurred over here. So when this happened on August 6th, the daily chart was right here. It was just a quick little pullback. That's it. You know, it was just a quick little bullish candle. It wasn't even pullback or nothing, right? So that was just telling us that this is not over yet. This is just a quick little pullback, because this is wave 4. We still have a wave 5, right? So when we had this little pullback, at this point, this potentially people could have seen this as a rejection of 0.618, right? But in reality, this was only a wave 4 pullback on the 4-hour chart, and we still have a wave 5. That is why this continued to go farther on a daily time frame, because a trend on a lower time frame tells us what a daily chart will do. The lower time frames will tell us what the higher time frames will do, right? And that's exactly what happened here. So that's kind of it for this example. I'll go back to the drawing now and I'll show you a little bit more within the drawing itself. But when it comes to explaining Elliott wave theory and multi-timeframe analysis, this is the main thing that you need to understand. Run on a higher time frame will be a trend on a lower time frame. So we have a wave 3 on a monthly chart, should give us a whole 1, 2, 3, 4, 5 on a daily time frame, and so on. That is the whole fractal principle. So let's have a look at the drawing and I'll go a little bit deeper. So what I'm going to do here now, when we go into the drawing, I'll just build on that same drawing that I did in previous lesson, utilizing Fibonacci retracement and extension, and start adding a little bit of the multi-timeframe analysis concept into it. So now you already understand that I showed you within the actual live data of what it looks like. A run on a higher time frame is a trend on a lower time frame. That's all you really need to know. So a run is a wave 3, a wave 5, a wave 1. So on a lower time frame, that's just going to be a 1, 2, 3, 4, 5, the whole wave cycle, the whole 5 waves, right? A run is a trend and so on. So when you look at the drawing here, we have the whole wave cycle here of a 1, 2, 3, 4, 5. We have a simple pullback. We have a little bit of a complex pullback with this A, B, and C, and so on. So assuming this is a daily chart, well, on a monthly time frame, this could be a whole brand new run, starting at the exact same level at the lows. So in a monthly chart, this would literally be a run. It will look like that, ending over here. So this could be one whole run on a higher time frame. Even if this is a 4-hour chart, right? 1, 2, 3, 4, 5 on a 4-hour time frame, this could be a whole new run on a daily chart, just a run, right? Just a whole straight run, just like how we have seen in the previous example, right? So this is what I mean by that. Elliott wave theory utilizing multi-timeframe analysis, right? So this is just a run on a higher time frame. So this could literally be a wave 1 run, a wave 3 run. It could be a wave 5 run, right? Because those all are runs. So it's, as long as this is a run on a higher time frame, I mean, it will develop this trend, this whole 1, 2, 3, 4, 5 wave cycle on a lower time frame. So let's build on this a little bit more, right? So let's move this to the side. Just, I'm gonna put a note. This is just for, just for the sake of it, I'll put a note here. This is a wave 1 breakout on daily. Okay, so this is wave 1 breakout on daily. Whereas this right here, in comparison, could be the 1-hour chart, right? Let's just say this is a 1-hour chart and this is a whole run on a daily time frame. So what could we get now? Obviously on a daily chart, the thing that comes next is a wave 2, right? So this would be, now we would be expecting a wave 2 happening on a daily chart. So let's draw in our Fibonacci. Let me split this on 2. So let me do something. Right, so the screen on the left, this is the lower time frame, the whole trend. Screen on the right is the higher time frame, utilizing the same move, right? So starts at the exact same level, ends at the exact same level, right? So on the lower time frame, right here, it's a whole 1, 2, 3, 4, 5. On a daily chart, this is wave 1. So now on a daily time frame, we should have what? Beginning of a wave 2, right? So wave 2 is beginning. We're assuming obviously it's going to end somewhere at 0.382 Fibonacci, right? That will be the end of wave 3, or sorry, wave 2, end of wave 2, wave 3 beginning, somewhere over here. Well, what would that look like on the lower time frame, such as the 1-hour chart? What could that look like on a 1-hour time frame? Well, we could have 2 options. We could have a corrective wave, such as an ABC, or we could have a whole 5 waves, 1, 2, 3, 4, 5, right? Because this is still a pullback on a daily chart, and if this pullback is significant, actually large, quite large, then that could be a whole 5-wave cycle on a lower time frame, or it can just be an ABC. So, talking about corrective waves, this could literally look something like that. A maybe rejects this previous wave 3 high, and it might seem like it's actually continuing higher, but in reality it may not, simply because if you look at the higher time frame, at that point this is not a full pullback. So if you look at this in comparison, right, we have this pullback that's happening on the lower time frames, the time frame to the left, right? And we're potentially stalling at the previous high, what was once resistance right here, wave 3, could become support. But if you look in comparison on the higher time frame, utilizing multi-timeframe analysis, this is a wave 1 breakout, so wave 2 should continue all the way to 0.32. Obviously, there will be times where it could stall here and just have like this shallow pullback, and then it just can continue going from there. But a lot of the times, it will continue going down all the way to 0.382. And if that's the case, then obviously this is not finished, this pullback right here is not finished. So that would mean that we're going all the way farther down right here into this whole corrective wave. Let me just adjust this a little bit more. So this will now be a corrective wave. And a corrective wave is again an A, a B, and a C. And what we would have now in this example, in this case, this would be a wave 2 finishing on the daily chart in this case, right? This is just using multi-time frame analysis. So wave 2 has finished, and now what? A wave 3 begins on a daily time frame, right? So again, we will use our Fibonacci extension for this. And now we have some potential targets for wave 3. I mean, that would be all the way up there as the first major target, 1.272. So on a lower time frame, literally this would be beginning of a brand new trend or beginning of a brand new wave cycle. So as the daily chart is moving into this wave 3 run, right, utilizing multi-time frame analysis on a lower time frame, that is beginning a brand new trend, a brand new wave, 5-wave cycle. So this would be now a wave 1 breakout as an example. It might even be a little bit shallower like that, right? So this would be a potentially wave 1. Let's actually adjust this a tiny bit. Move this over. There we go. So wave 1 breakout. Let's say this is a breakout simply because, hey, you know, we broke the previous highs, right? So this is now wave 1. This would be a wave 2 pullback. Hey, check it out. What do we have? Left shoulder, head, right shoulder. Inverse head and shoulder pattern. Wave 2 finishes. We start a brand new wave 3, right? So wave 3, wrong arrow. There we go. So wave 3 would go pretty high, and then eventually we would go wave 4 and finish with wave 5 all the way up there, right? So this is what multi-time frame analysis looks like utilizing the Elliott wave theory. It's just always the same concept. A run on a higher time frame is a trend on a lower time frame. This is just how it looks like when you count the waves, right? So this pullback on a daily chart or a monthly chart or whatever, this wave 2 pullback, a lot of times it's just an ABC corrective wave on a lower time frame, right? Sometimes it can turn into a whole new bearish trend like a wave 1, 2, 3, 4, 5 on a lower time frame if that pullback is actually massive, right? But a lot of times it might just be an ABC, and then it starts a whole brand new 5-wave cycle as the higher time frame goes into wave 3 or wave 5, right? So that is it. That is it for the Elliott wave theory lessons. I mean, at this point, this is the whole picture. When you start adding multi-time frame analysis into it, that's the whole picture of Elliott wave theory. It's again the fractal principle. Multi-time frame analysis utilizing the Elliott wave theory is just the fractal principle, meaning that these patterns continue to repeat as we zoom in on the lower time frames or zoom out on the higher time frames. Right? What happens on one time frame will continue to repeat on a lower time frame. So like as an example, again, wave 3 run on a daily chart will be a whole 1, 2, 3, 4, 5 on a lower time frame, such as the 1-hour chart, and so on. So at this point, you guys know everything there is to know in regards to the Elliott wave theory, what it is, how it functions, how we use the Fibonacci retracement within it and the Fibonacci extension, and how we use it utilizing multi-time frame analysis, that fractal principle that Mr. Elliott was talking about when he discovered the Elliott wave theory. Now, that is it. In the next lessons, moving on, eventually we're going to be digging into the strategies themselves. The strategies, when we look at the strategies, we will also be talking about the Elliott wave theory, and we're going to be talking about multi-time frame analysis. When we move on to the management, we're also going to be talking about the Elliott wave theory and multi-time frame analysis. So we're not done with this yet. As we move on, there's just going to be much more explanation of it all because the strategies are built on this, right? So every single strategy that we look into, we will be looking at many more examples of this. When we dig into the management, we're also going to be looking at many more examples of the Elliott wave theory and multi-timeframe analysis. So you have much more of this information coming to you, but at this point, this is enough. So that is it for this lesson. I hope you guys enjoyed it, and I'll see you in the next one. Take care.